Joining me today, as always, is my co-host Ryan. Ryan, how are you today?
It's hot and humid, which means the summer is about to approach. Either that or it's the wildfires somewhere across Canada. But besides that, this topic is interesting because you've talked about this, and there's a lot of there's a lot of advisors that don't really understand this, and there's a lot of people that don't know anything about what we're going to talk about today,
Mm,
which is exciting because it's educational for me too, because I always rely on a team for specific ventures or specific strategies. I think that's
mm,
a key component of us is like we're working off each other, we're using and leveraging each other's skills, and this is a skill set that I know that I need to bring specialists in for, and for advisors that swear that they know everything. You can't possibly know everything because things change quite often, and I know there's something that it's referred to, so I will let you kind of take the reins as to what it's been
okay.
referred to in the past and what we're talking about today. So, yeah.
Yeah, well, we're going to talk about unlocking wealth
Hmm.
using your mortgage. It's known as the tax deductible mortgage strategy. Some people may have heard it as the Smith maneuver. A Smith maneuver was a strategy that was created in the early 80s by a gentleman named Fraser Smith, based out in BC, where he figured out a way of converting your mortgage, which in Canada, the interest on a mortgage is not tax deductible like it is in the States. But he was actually able to put together a strategy that has passed CRA's requirements. Okay, so this isn't something that we're testing. It should pass, it might pass. Like this actually has been tested by CRA,
Hmm.
where you can convert your mortgage into a tax deductible mortgage and potentially help increase wealth. So, one of the reasons why we're talking about it now, the first thing I'll say is 15 to 20 years ago, this was common. Like a lot of people were talking about it. It was, we had seminars and not necessarily webinars, but lots of seminars that talked about the strategy itself, books, marketing, advertising. I swear, I think every advisor that I came across was offering the strategy, and then it's quiet down for a while now. Um, One of my challenges with it, because this is something that I was also offering 20 years ago. So actually, it's the reason why I met my first partner, business partner John,
Hmm.
because this was a program that a strategy that I was offering some clients. I needed, you know, a mortgage advisor that I could trust, and a mutual friend of ours connected us. And he was very familiar with the mortgage, the tax deductible mortgage strategy from the mortgage broker's perspective, and that's how we originally actually connected, and then ultimately created TVH Group as a result. But the challenge that I had with it many years ago was it was sold, the strategy, as if it was the best thing for everybody. So anyone had a mortgage,
Hmm.
this was the solution. You had to do it. It was right for everyone. And if you didn't do it, there was that FOMO that you talked about, right, in other podcasts. Um, and you and I, again, we've always said we're not believers that one strategy or one product is for everyone. There are strategies out there, there are products out there that are suitable for certain people and maybe not for others. So
Yeah.
today we're going to talk about it. We're
Yeah.
not recommending it today. This is more of here's maybe another solution that you may have not considered. And it is something that if you feel it might be beneficial to you, that you might qualify for this type of strategy, then we'd be more than happy to talk to you. And I guess at this point it'd be primarily me right now, Ryan, because you're still learning about the strategy. But that's
Yeah.
okay. You can still reach out to Ryan, and
Yeah.
we'll work together on it, right?
Well, we've always talked about being tax efficient and how to create wealth, right? And I feel like as Canadians, especially, we pay high taxes, we have inadequate pensions, we're paying our mortgage with after tax dollars. We have our kids going through, you know, growth and tuitions and things like that. So, and then also we're trying to keep up with inflation, however that, and we're balancing all these things. So, I think it was really important. for us to tackle subjects like this and talk about, what truly is a mortgage costing for some people, and how we can maybe perhaps introduce a strategy that may not be for everybody. We would go through a risk assessment with somebody when tackling this. Again, you mentioned this about a year and a half ago to me, and I've done my research, but I've never gone through it with any of my current clients. Some of them just aren't prepared to take that type of potential risk. But as a Canadian, we're obviously working with a lot of clients that are trying to tackle two goals, which is save and prepare for retirement, and as we've talked about in a previous episode, about the idea of paying off your mortgage and what that kind of snowball effect can happen, whether you're just throwing all your money towards your mortgage, or if there's different strategies. And again, as you've kind of mentioned already, really this is about introducing people to other opportunities that may work for them as a strategy. So and people's mortgages are pretty big as far as the equity that they sit on, right? So
Well, I think there's the equity component, there's the size of the mortgage, but I think another reason why now is a really good opportunity to consider the strategy is the fact that the interest rates are on the higher end. They've come down over the last couple of years, but they're still on the higher end. And again, if there's a way that we could create more tax savings, because that's the thing about the strategy as well, that once we get into it a little bit deeper, it's not a deferral of tax like an RSP contribution would be.
mhm,
You are creating new tax deductions. There are tax savings as a result of the strategy itself. So I
yeah,
think timing of it is pretty good now in terms of having this conversation. But again, I'm going to stress once again, we're not saying that everyone should get involved with this. This isn't for everybody. And I think that's what the issue was about 20 years ago. And the regulators were definitely all over it,
yeah,
because I think every mutual fund advisor was recommending the strategy, even though it wasn't, because it is a leverage strategy. So we should make that clear as well, right?
yeah. All right. So I guess the question, Jim, is what what is what is the tax deductible mortgage strategy?
All right. So the tax deductible mortgage strategy is a way that you can convert your uh, non-tax deductible mortgage into a tax deductible mortgage. And I'm just going to go through the basic mechanics behind the strategy as well. And there's different variations on how you can do this. I'm just going to go with kind of like the basic right now, where every single month as Canadians, Ryan, you have a mortgage, I have a mortgage, we're making mortgage payments. And what we're doing is that we are reducing the debt that's owed to the bank, and we're building equity in our principal residence.
Mhm,
The problem with that equity, a lot of Canadians are actually relying on their home equity as part of their retirement strategy.
mhm,
In fact, I believe like well over 70% of people's retirement
yeah,
is reliant on the equity that's in their home. And then they have to make some decisions. Either they're going to have to sell the asset in order to unlock the equity, right? Um, so if you do that, you may take the proceeds and downsize. But downsizing nowadays doesn't really mean you're going to be paying that much less than perhaps what you receive from your home, right?
yeah,
Another option is potentially to do a reverse mortgage, something that we've talked about. It's something that we also offer as a potential strategy for the appropriate individual, but that's a way of unlocking some equity from your home, not all of it, right? So what with the strategy, what it allows you to do is every single month, as you're making that payment. So let's use just round numbers right now. So let's say your mortgage payment is $3,000 per month. You make that payment on your home, and you're paying off $1,000 of that is towards the principal of the mortgage.
mhm,
So over the year, you're paying down, call it $12,000 in year one in this example, and you're slowly just building equity in your home. What the tax deductible mortgage strategy allows you to do is first you have to have what's called a readvanceable mortgage. That's very important with this strategy. Not every bank offers it. Some of them actually took that type of product off the table for a while. Now they're coming back in again. So you need to have a readvanceable mortgage. And the way the readvanceable mortgage works is that $1,000 payment that you make at the end of the month, the following month, what it does is it increases a line of credit that's attached to the mortgage. Okay, so think of it almost like an elevator effect. Here's your principal, and every single month that you're putting money into your principal, your line of credit limit increases. Now, some people think, wow, that's great. I get access to this line of credit and I can go out and buy a boat or go on vacation. No, that's not going to work. What you then need to do is you take that $1,000 and you invest it in a non-registered investment. So it can't go into an RSP for the strategy to work.
Yep.
It cannot go into a tax-free savings account. It cannot go into a whole life insurance policy like some advisors were recommending. It has to go into a non-registered investment that's earning some form of dividend or income as well.
Yep.
It doesn't have to necessarily go into a portfolio. It could go into real estate. It can go, if you're a business owner, it can be invested back in your business. Essentially, it just has to be invested into something where you're expecting a return from that investment.
Mhm.
So now you take that $1,000 and let's assume that we're placing it in a portfolio. That's a dividend income generating portfolio. That $1,000 that you invested off of your line of credit, now you're going to be paying interest on that $1,000 in the first month. That interest on that $1,000 is now a tax deductible expense because you've used the funds to invest.
Mhm.
And then what will happen is the following month, it's another $1,000, right? Paid out of the principal, readvance the line of credit. You then take that and you reinvest it. So in year one, in this scenario, very simple scenario, you've taken $12,000 and you've invested it in some form of portfolio. So now what that also does is it now has two assets that you are now investing in. And Ryan, how do high net worth people basically build their wealth? Right? It's not from the accumulation effect,
Yep.
it's from the multiplication effect.
Yep.
So in this instance, we're creating that multiplication. And now we have your real estate asset that's growing in value. You are paying down the principal on that, right? So that's still being paid down, but now you're increasing a line of credit where you're investing those assets. So there's the multiplication.
Mhm.
Very simple. Okay. Now, the next thing that happens is, let's say on that $12,000 in year one, I don't know, at call it 5% ish, right? You're going to create let's call it a $600 tax deductible expense on the interest. I don't have the exact numbers. My math is off today, but it's around, call it $600. So the following year, you now have a $600 tax deduction that you can claim. And depending on your tax bracket, you may get, and I'm using again very simple, basic numbers, small numbers here. You may get $100 refund off of that $600 tax deduction that's been created.
Mhm.
Well, now you take that $100 plus your monthly pay down, and you reapply that as an additional payment on your mortgage. And over time, over the years, that's going to just keep snowballing and
Mhm.
compounding. Right, and we recently talked about the compounding effect. So in year one, it's not going to look that great, but gradually over time, as we're compounding and snowballing, it's actually very material in terms of the amount of tax deduction that you receive, the portfolio that you build, right,
Mhm.
and that multiplication effect between the two assets.
Yeah.
Okay, another way you can do it, I've had recently had a client say, we may have about $100,000 from a sale of other investments and assets, and we're just going to pay down the mortgage with that money. And I suggest, well, what if you pay down the $100,000 on your mortgage into a readvanceable line of credit, and then take that 100,000 and invest it, and now you've created a tax deduction on, if it's at 5%, that's $5,000 that you've created on that number, right?
Yeah.
And that now becomes a tax deduction the following year. They claim it, they get another, call it $2,000 back just from that component. They put that on their mortgage and on and on and on.
Yeah.
So typically, by implementing the strategy, if this is all you do and you follow it to a T, you may reduce your amortization by 4, 5, 6 years, depending on your tax bracket. But just by simply doing that, you can automatically decrease your amortization schedule.
No. At the same time, you're creating the wealth side of your investments that are going to work towards your retirement, right?
Well, now you've unlocked that equity
Yep.
by taking out that line of credit. Now, it is still a debt that you owe.
hmm
So a lot of people are like, well, we're not really eliminating the debt. All we're doing is transferring the debt. Absolutely, but you're transferring to something that becomes tax deductible.
Yep.
When you run the calculations at some point in the future, and we're talking like this isn't something that's going to make any significant changes for you financially, like if it's a 5-year time horizon, that's just
Yep.
not going to work,
Yep.
right? We're talking 15, 20, 25 years. And over that period of time, if your $1 million real estate asset is now worth 2.5 just based on 3% per year growth, and you've converted your $800,000 mortgage into an $800,000 line of credit, interest only. So
Yep.
all you're doing is just you're paying off the interest to claim that deduction, and that $800,000 is converted into a $2 million portfolio, as an example.
Yep.
You're up by 1.2 million on the one side with the portfolio, and whatever the house is worth. Your net worth has increased regardless,
Yeah.
right?
And I think one of the big things that you mentioned before, I think in your infinite wisdom too, we've talked about debt, and really, as you kind of just said, you're taking a non-deductible debt, right, which really destroys wealth, and you're turning it into something that is tax deductible and helping you create wealth and open up opportunities for you, right?
Yeah.
Um,
And what I'd like to do is I'd like to maybe just show a basic illustration, if
yeah,
that's okay. So we've
I love
created
pictures.
a yeah. Well, I love calculators, and we just created one that is available on our TVH financial website. So what you're going to see here is this is the main page. If you go to the top right hand to more, and you're going to find the calculator section. So there's the tax deductible mortgage, there's the lost opportunity cost, and we just added the RIF calculator. So if we go to the tax deductible mortgage, you'll see basically how the program works. So it'll explain what the program is. In this scenario, we're going to say, let's say the house is worth $800,000. You put down $160,000 down payment. Your mortgage is at 5.5%. Your marginal tax bracket is 43. Home appreciation 3.5. I'm just going to use the defaults for now. I just want to kind of illustrate the concept itself. Investment portfolio 7% net of fees, and we're looking at a 25-year time horizon. So what this eventually does is it creates an annual tax savings of about $15,000. It's kind of calculating what your monthly payment is. Your future home value after 25 years is going to be about 1.8, almost 1.9 million. And we've created a portfolio of almost $1 million by implementing the strategy, which isn't too bad.
Yeah. Yeah. So,
Sorry, I had a cough there. Um, so if we kind of break down the numbers on the left, if we just stick with let's aggressively pay down the mortgage and not worry about the strategy itself, what happens? Well, at the end of the 25 years, you pay down the mortgage, and then congratulations, you have a $1.9 million asset that you're living in and enjoying. Can't do anything with it, right? Now,
mhm.
you can again sell it and walk away from your home. A lot of people don't really favor that, but that's an option. But if you're going to buy something with some of the proceeds, you might walk away with $800,000 if you bought something for $1 million. Because again, we're not seeing that much difference in pricing right now, even if you just kind of downsize, right?
Mhm.
Or you can take a reverse mortgage. Reverse mortgages, depending on what age you're at, the max you can take out is about 55% of the value of the home. So about half of what this is worth, right? Now, if we look at the strategy on the right, we have the tax. Again, we built off, or we paid off the house, and we have a portfolio of $960,000 approximately. So we've increased the portfolio or the net worth significantly
Yeah.
at retirement. Okay. So this is just a very basic calculator um, that we can use. We do have some more detailed calculators that will start to calculate more the taxation side, the actual pay down of the line of credit potentially, right? So there are some, because that's something we have to incorporate as well. But it's something to consider as a
Yeah.
potential option, but not for everyone. There's reasons for that.
Yeah. And that's why we also, again, as a, I guess a disclaimer too, is that's why we get an accountant involved. We get a mortgage specialist involved. We get, our very own lawyer involved to make sure this is the right fit for somebody. So instead of going to 12 different places trying to find TVH group, you're able to go to one group to be able to bring all of us together to talk about each individual strategy and how this may or may not make sense for them, right?
Yeah, well, again, the important part of the strategy is that readvanceable mortgage.
Yeah.
So we can connect clients with John on the readvanceable mortgage side of things, right? And he can make sure that that's what he's putting in place for a client because of the strategy. Obviously, on the legal side, we need someone to process the mortgage, so we have that in house.
Mm-hmm.
Accounting is really important here. So one of the things, so if you do this and you have a readvanceable mortgage, and you use some of the line of credit to pay for home improvements, go on vacation, buy a motorcycle, and some of it is for investment purposes. If that's not clear in terms of what's been for personal use and what's been for investment, CRA is going to have a problem with that.
Mm-hmm.
So it's very important. With some readvanceable mortgages, you can carve out different lines of credits. So you can say, well, this line of credit is only for the investment piece. This line of credit is for emergency and whatever else. So as long as you can clearly define that, then you're okay. But the other thing too is what we recommend is having a separate bank account to run the strategy through,
Mm-hmm.
because one of the things you can deduct is any banking fees. So if you're using a bank account that has fees associated with it, that becomes tax deductible as well,
Yeah.
right? So usually we recommend is have a separate bank account, and we like to set clients up with a Manulife One bank account, or sorry, a Manulife Advantage account. And the reason for that is because we will also have access to that information with the client's authorization, and we'll be able to see some of the transactions that run through. So then after that, once we identify what the expenses are and what the income has been, and all those things, then it's easy to package that up and give it to the accountant. If you don't have an accountant who understands the strategy, we do,
Yeah.
right? So there's a lot of moving parts. It seems complicated. It really isn't if you know how it works.
Yeah.
But what I can say is we can confidently assist you in setting it up. And finally, we can also make the investment recommendation that's appropriate for this type of strategy.
Yeah.
Right.
I think a lot of things come to mind when you're talking about this is, again, our cash flow solutions and the coaching piece, right? For people that really want to take advantage of, you know, reaching their retirement goals, because I think we've talked about this before and maybe a real life example of people who start too late, right? The importance of starting early, the importance of compound interests, and that snowball effect that happens, and being able to teach kids and young adults that early enough that they really understand that point, and how putting off some of the immediate gratification things, as you said, all of a sudden I have all this money, let's buy a boat, let's buy the motorcycle. That can be part of your longer term strategy, but that's not the immediate goal that we would look at, essentially, because I think it depends on the client's goals. Ultimately, is what is your goal? Is it retirement, or is it to have these certain items within your family dynamic that are able to have fun with? But I think for a lot of people, and a lot of Canadians too, facing significant debt or not truly understanding their cash flow, I think this is where the coaching sessions often come into play, of being able to have somebody on your team to keep you on track when it comes to remembering and helping you stay on course when it comes to what your ultimate goal is, right? And
Yeah. I was going to say the cash flow piece is really important because I think where there was a major issue with some of the regulators. First of
Yeah.
all, it's a leverage strategy.
Mhm.
And a lot of the advisors were not disclosing that they were leveraging to invest in the mutual fund portfolio.
Yeah.
Secondly, and I saw this a lot, they weren't relying on the actual client's actual cash flow based on their own income. What
Mhm.
they were doing was with the projections, they were putting them into mutual funds that were paying out, call it a monthly or a quarterly distribution, and using the distributions to pay the interest expense on the line of credit.
Yeah.
That's like really riding a fine line, right? Because if all of a sudden the distributions change, which they did,
Yeah.
or if the interest rates go up, which they did, and you can't support the strategy with your own cash flow,
Yeah.
you're in trouble. And then unwinding these strategies can become very costly.
Mhm.
So that is why, again, like we don't make the recommendation just strictly on, hey, this sounds fantastic. Everyone should do it. Create this tax deduction. Don't get into RSPs. This is better because some people were actually marketing it that way as well. This is better than an RSP or this is an RSP replacement strategy. No,
Mhm.
um, you have to be again very responsible because there's risk associated with it. So there's market risk. So if you're investing in a portfolio or an investment that there's market fluctuations, what if you're down 15%? Can you stomach that?
Yeah.
That could be a problem, right? Again, if it's structured in such a way that you're relying on that distribution to support the interest expense, what if that changes?
Yeah.
That's another level of risk, right? So these are all things that we factor into play before ultimately making a recommendation. So is it for your mom and pop who are barely scraping by every single month? Like, no, absolutely not. That's too dangerous to get into this type of strategy. It's someone who's again has the cash flow, has excess cash flow, right? And I'm not saying like an extra $100 a month of cash flow. Like it has to be something significant and meaningful. So that way, if there is some variation in interest costs, or we don't actually incorporate the distribution to
Mhm.
support the payment, so that's never part of our calculation is that we're going to place anyone in a portfolio relying on the distribution ever to help cover the interest expense. That's never, if we have to get to that point, then automatically by default, it's not the right strategy for you,
Yeah.
right? So those are some of the risks that we have to worry about.
So I guess my question is really, as I kind of said, like going through somebody's cash flow is first and foremost probably one of the most important pieces of discovering whether this strategy is right for you. Is there anything else
Mhm.
that you can mention as for somebody to start thinking about this or approaching us as a potential strategy for themselves?
Well, I think it's more of, if you're coming to us because you need support in behavioral cash flow planning,
Mhm.
don't even think about the strategy,
Yeah.
right? Because it means that there's a cash flow problem to begin with, and this is just not a solution for you.
Mhm.
If you're someone that you're finding that, what, you're maxing out your RSPs, you have money in TFSAs, you still have additional cash flow, you don't know where to place the funds, you're at a higher tax bracket, so you're paying a lot of tax, then that's something we need to consider,
Mhm.
right? You might be a candidate for this strategy.
Yeah.
If you're someone that's constantly changing jobs and job stability is a problem, this is probably not something you should be considering at all,
Mhm.
right? So it's more of if you're looking for something that's a little bit different that you've never thought of before, and you're looking to place additional funds somewhere, or if you're someone who likes to aggressively pay down the mortgage just because you feel like that's the right move for you, this is a way that you can pay down the mortgage, re-advance in a line of credit, create an investment portfolio, and increase your net worth. So that's someone else that might want to speak to us about a strategy like this.
Yeah. Well, we do work with people that are wealthy but still don't understand their own cash flow, and I think that's one of the things that sometimes is baffling for people too is the importance of teaching cash flow, and that
Mm,
the freeing up even more money than you realize that you had, because you're so used to just turning over, um, and buying whatever it is that you want or need,
mm,
realizing that, by going through the cash flow strategy too with a lot of people, um, they're 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 freeing up a lot more money than they even thought they had. I know there's a bank out there that promises you have more money than you think, or something along those lines,
yeah,
um, and you can be, as long as you understand your own cash flow, because it's definitely not taught within the schooling system. Budgeting
right,
is, which is all short-term goals, right? So,
yeah.
so back on kind of my thoughts too is, are there any other real life examples that you've come across more recently, or that you've done with clients that have can help more people out there decide whether this is right, or is it maybe just best that they reach out to us?
Well, I think reach out to us, but there was that one example where I had a client literally who said that they were going to put $100,000 and pay down their mortgage with it. And when I
Yeah.
walked them through the scenario, they're now reconsidering that decision,
Yeah.
right? And they had said, "Yeah, I kind of heard of that strategy. Don't really know how it works." So we quickly ran through it, and they thought this makes sense.
Mhm.
Because the other thing that we like to teach people is having use and control of their own money. So you pay down that $100,000, it feels good, but it's very hard to get it back. When you structure a readvanceable mortgage, you do kind of get it back by creating that $100,000 limit, and then you could again continue on building your wealth if you borrow against that money responsibly,
Mhm.
right? And invest it. Like, we're not saying put it all into Bitcoin. That's not a good idea. I don't even know if that would qualify because it doesn't produce any income, right? So it has to be very specific in terms of the type of investment that you can get into in order for you to be able to claim the interest expense as a tax deduction, um, by borrowing those investments, um, or borrowing to invest,
It was a good reminder
right?
that you said at the beginning, which has to be a non-registered.
Yes,
Yeah. Okay.
that's very important. And then depending on the structure, if you're in a certain portfolio, some portfolio managers, because the management fee is kind of stripped out of the portfolio, the management fee is also a tax deductible expense. So you've built a portfolio where you've created the tax deductible expense on the interest cost. If there's any banking fees, you've created another tax deduction as well.
Mhm.
And depending on the portfolio management solution, how they price their fees, there's an additional tax deduction that would be offset against some of the income that's distributed within the portfolio.
Mhm. Yeah.
But again, you need to speak with the accountant and the appropriate portfolio manager to make sure that that all passes.
Yeah. Okay. Well, I don't. My final. I don't know. I don't know. This final thoughts for myself. I think one of the biggest things is education is the key component to all of this. Nobody else is going to do this for you, so you have to be able to support yourself and make sure you're doing the right education, and finding the right team to support you when making a decision like this. Because as you said,
Mm,
it's risky, but with some risk can be some reward. But you have to have the risk tolerance for that, right? So,
yeah,
um, and really, when it comes to wealth strategies, this is a wealth strategy that some do, uh, and I think it's something for some people out there to consider, and really to shift your mindset when it comes to, I just need to pay my mortgage off, and
mm,
that's your strategy. That's okay, but know that you're losing out on potential opportunities. And what
mm,
are you going to do with that? You have what people some say is this asset that you're living in that really isn't actually worth anything, and sometimes not staying up with inflation depending on the time of the year. So
Yeah.
I think it's important for people to think outside the box, and this is one of those things. And I'm sure it was really, really exciting to read through the tax booklet. So sleepless
Yeah.
nights, or put
Yeah,
yourself to
for
sleep.
sure.
So yeah.
For sure. So that's it. Again, if you want to look at, it's a very basic calculator. There's a lot of there's additional moving parts to it as well. We'd have to take into account, but this is just a basic calculator. But if there's any other questions, obviously feel free to reach out to us. Go online. Online, you can find us at tvhfinancial.ca. We suggest that you like, share, our podcast and our YouTube episode as well, and check out our blog post on our website. Anything else, Ryan, before we shut her down?
No, think outside the
We're
box.
all good?
Yeah.
Alrighty. Well, everyone, appreciate your time. Once again, Ryan, thanks. Have a wonderful day.
Take care.